Imagine a document, just one, that shapes how millions of people secure their future, protect their assets, manage risk.
And it comes from a place really known for its meticulous attention to detail, Japan.
Exactly. Today we're taking a deep dive into just such a foundational legal text, Japan's Insurance Act, specifically Act number 56 of 2008.
That's right. And our mission really is to unpack this thing, demystify its pretty intricate structure,
Yeah.
unearth its core principles.
And highlight the crucial distinctions and, the protections it offers. They're surprisingly robust.
They really are for individuals and businesses.
And just so you know where we're getting this from, our insights are drawn directly from an official English translation of the Act itself, so it's the source text.
Foundational legal text defining insurance in Japan.
So whether you're maybe gearing up for a global business meeting or you're just curious about international legal frameworks.
Or even just want to understand the rules behind something as common as, say, your car insurance or life insurance.
Right. This deep dive should give you a shortcut to being truly well-informed. Okay, let's unpack this.
Let's do it.
So we have to start at the beginning, right? Chapter 1. The general provisions. This isn't just definitions. It's like the foundation.
It really lays the groundwork. Article 1, right off the bat, tells us its purpose. It governs the formation, effect, performance, and termination of all insurance contracts.
And it makes clear it works alongside other laws and regulations. It doesn't exist in a vacuum.
Precisely. And then Article 2 dives straight into the key definitions. You really need these to understand the rest.
Okay.
It defines an insurance policy basically as this contract where one party, the insurer, promises to pay out usually money for life and fixed amount A&H policies.
A&H being accident and health.
Yes, accident and health. They promise to pay when a specific contingent event happens.
And in return, the other party, the policyholder, pays premiums based on how likely that event is.
Exactly. So insurer pays out, policyholder pays in. Then you've got the insured.
That's the person whose risk is covered, right?
Yeah.
The one who might suffer a loss in non-life insurance.
Or whose survival or death triggers the payout in life insurance. Or whose injury or illness triggers it in fixed amount accident and health.
Got it. And the beneficiary?
That's simply the person designated to actually receive the payment for life or fixed amount A&H policies.
Okay. So those are the players. But what about the types of insurance? The Act makes distinctions.
Oh, absolutely. And this is fascinating. A non-life insurance policy is there to compensate for actual loss from some contingent event.
Like your car gets damaged, the policy pays to fix the damage, the actual cost.
Precisely. Compensates the loss. Now, here's a nuance. An accident and health insurance policy is technically a type of non-life policy.
Okay.
Yeah, but it specifically compensates for loss from injury or illness, and it's limited to the loss suffered by that person. Think medical bills, lost income due to an accident.
Right. So it's still compensating actual quantifiable loss, but specifically health-related.
Exactly. Contrast that with a life insurance policy. This promises a fixed payment based on survival or death, not compensating a loss, but a pre-agreed sum.
So it's not about proving financial damage, just the event itself, survival to a date or death.
Right. And similarly, a fixed amount accident and health insurance policy also promises a fixed payment for injury or illness, like life insurance in structure, but tied to health events, not death or survival.
That is a super important distinction. Is it about compensating actual loss, or is it a fixed payout for an event? Changes how you view the policy entirely.
It really does. Understanding that core difference is key.
Okay, so with those fundamentals down, let's explore Chapter 2.
Yeah.
Non-life insurance. This is the stuff most people encounter, right? Car, home, business protection.
Yeah, protecting against loss. Section 1 starts with formation, how these agreements get set up.
And Article 3 immediately gives us an example of that Japanese precision you mentioned.
It does. It says only interests you can actually assess in monetary terms can be insured under a non-life policy.
So you can insure your valuable painting because it has a market value.
Exactly. But you couldn't insure, say, your sentimental attachment to the painting, because you can't put a price tag on that feeling for loss calculation.
Makes perfect sense. Can't quantify the feeling. And Article 4. That sounds important. Duty of disclosure.
Absolutely critical. When you take out a policy, you, the policyholder or the insured, must disclose material facts about the risk, whatever the insurer requires.
It's about transparency from the start, building that trust.
It is. And Article 5 on retroactive insurance reinforces that transparency. It stops people from trying to, game the system.
How so?
Well, if a policy tries to cover an event that happened before the policy was concluded, that part is void if the policyholder or insured knew the event already occurred.
Ah, so you can't insure a burning house after it's already on fire.
Basically, yes. And equally, it's void if the insurer knew the event hadn't happened or couldn't happen before the offer was made.
So it prevents bad faith on both sides. That's smart. No insuring things that have definitely happened or definitely won't.
Exactly. And Article 6 follows that up by requiring the insurer to promptly deliver a policy document spelling everything out: names, event, period, amount, premiums, dates, all the key details.
Clarity again. And Article 7. You mentioned protections.
Yes, this is a big one. It's a mandatory rule. Any contract clause that contradicts that duty of disclosure in Article 4 or the insurer knowledge part of retroactive insurance in Article 5
Mm-hmm.
and is unfavorable to the policyholder or insured is just void, gone.
Wow. So the Act actively overrides unfair contract terms on those points.
Yeah.
That's quite protective.
It really is. It sets a strong baseline for fairness.
Okay, so the policy is formed fairly. What happens when it's live? Section 2, effect.
Right. Article 8 is straightforward. If the insured isn't the policyholder, they still automatically get the benefits.
Makes sense. And then Articles 9, 10, and 11 seem to offer flexibility.
They do. Protections for the policyholder. If you accidentally overinsured something, say, the insured amount is way higher than the actual value. Article 9 lets you cancel the excess part, provided you weren't grossly negligent.
Okay.
And Articles 10 and 11 let you request reductions in the insured amount or value and lower premiums if the actual value or the risk itself significantly decreases during the policy term.
So you're not stuck paying for cover you no longer need.
Exactly. And Article 12, again, makes these protections mandatory. Any contract term unfavorable to the insured, Article 8, or the policyholder, Articles 9, 10, 11, is void.
Consistent theme there. Okay, but what about when damage actually occurs? Section 3, insurance claim payment.
First off, Article 13 puts responsibility on the policyholder and insured. Once an event happens, you have to try and prevent or minimize the damage.
So you can't just stand back and watch it get worse. You need to take reasonable steps.
Right. Then Article 17 deals with exemption of insurer from liability. Generally, the insurer is off the hook for damage caused by the policyholder's or insured's willful act or gross negligence.
Okay, so intentionally burning down your own house
Yeah.
or being incredibly reckless.
Yes. Or damage due to war or major social disturbances. But here's where it gets really interesting.
Oh.
For liability insurance, where the policy covers damage you cause to others, the exemption for the policyholder or insured's actions is only for their willful act, not gross negligence.
Wait, so if I'm just grossly negligent and crash my car into someone else's property
Oh.
under my liability insurance,
The insurer generally still has to cover the damage to the third party. They can only refuse if you intentionally cause the damage.
that's a fascinating distinction.
Yeah.
The standard is much higher for the insurer to escape liability when a third party is involved. Shows
Then-
real sophistication.
Absolutely. It prioritizes protecting the injured third party over letting the insurer off due to the policyholder's negligence, unless it was deliberate.
Okay, wow. What about calculating the damage?
Article 18 says it's based on the value at the time and place the damage happened, if there's an agreed insured value that's used, unless it significantly exceeds the actual value. In that case, the actual value is used to prevent overpayment.
Sensible and complex situations, like being underinsured or having multiple policies.
Articles 19 and 20 cover that. Partial and overlapping insurance. They lay out rules for calculating payments when the insured amount is less than the value, or when multiple policies cover the same risk. It includes rules for how insurers sort out reimbursement among themselves.
So it ensures things are paid fairly and efficiently. What about when payment is due?
Article 21 says payment is due after a reasonable period needed to confirm the event happened and assess the damage.
And the catch.
If the policyholder or insured obstructs the investigation, the insurer isn't responsible for any resulting delay. Fair is fair.
Right. Now, Article 22, statutory lien on liability insurance. That sounds important for victims.
It's hugely important. Imagine someone injures you and they have liability insurance. This article gives you, the injured party, a direct legal claim, a statutory lien over the insurance payout money.
So the money doesn't just go to the person who caused the harm for them to maybe pass on.
Exactly. It gives the victim a direct right to that insurance money, cutting out the middleman and ensuring they get compensated. There are limits on how that right can be assigned to protect the victim.
That's a powerful mechanism. And Articles 24 and 25, subrogation. What's that?
That's basically the insurer stepping into the insured's shoes. Say your insurer pays you for your car damage caused by someone else. Subrogation allows your insurer to then pursue that responsible third party to recover the money they paid out to you.
Ah, so you get paid quickly by your insurer.
And they take on the hassle of chasing the person actually at fault. It also prevents double recovery, you getting paid by both your insurer and the third party.
Okay, got it. Lots of rules to make the claims process work smoothly and fairly. Now, Section 4, termination. How do these policies end?
Well, Article 27 is simple.
Yeah.
The policyholder can cancel anytime, for any reason, really.
Okay, but the insurer can cancel too.
Under specific circumstances, yes. Article 28 covers cancellation by non-disclosure. If the policyholder or insured intentionally or through gross negligence failed to disclose those material facts we talked about earlier, the insurer can cancel, but there's a time limit. Their right to cancel expires 1 month after they find out about the non-disclosure or 5 years after the policy started, whichever comes first.
So they can't just sit on it forever. That's good protection for the policyholder.
Definitely. And Article 29 is similar for increased risk. If the risk significantly increases after the policy starts and the policyholder or insured fails to notify the insurer as required by the contract, the insurer can cancel. Same time limits apply.
Okay. What about really bad behavior?
That's Article 30, cancellation on material grounds. If the policyholder or insured intentionally causes damage, commits fraud related to the insurance, or does something else that fundamentally breaks the trust relationship, the insurer can cancel.
Right. And what's the effect of these cancellations? Is it retroactive?
No, and this is key. Article 31 says cancellation is not retroactive. It takes effect for the future. However, the insured generally isn't liable for damage related to the undisclosed facts, the increased risk, or the material grounds if that damage occurred before the cancellation took effect.
So if you fail to disclose something and damage results from that specific undisclosed risk before they cancel, they might not have to pay that claim, even though the policy was technically active at the time.
Precisely. And Article 32, limitation of return of premiums, says the insurer doesn't have to return premiums if the policyholder committed fraud or duress, or if the policy was void from the start due to knowing retroactive insurance. Prevents rewarding bad acts.
Gotcha. And finally, for non-life, Section 6, Article 36, exclusion from application. What's this about?
It just notes that some of those mandatory rules we discussed, the strong consumer protections, they don't apply to certain specialized high-risk policies, like marine insurance, aircraft cargo insurance, nuclear facility policies, and certain large-scale business activity insurance.
So the law recognizes that these sophisticated high-stakes areas need different, maybe more flexible rules.
Exactly. It tailors the application of the Act.
Okay, that wraps up non-life. Let's shift gears to Chapter 3. Life insurance, focused on life events, obviously. Section 1, formation. Similar principles.
Similar, but with some crucial differences. Article 37, the duty of disclosure, is there, but it's about disclosing facts related to the likelihood of the insured event. So, health conditions affecting mortality risk, for example.
Makes sense. But Article 38, consent of insured, sounds really important.
It's profoundly important. It states very clearly that a death insurance policy where the insured person is not the policyholder.
So someone taking out insurance on someone else's life.
That policy is not effective without the insured person's consent.
Wow. So I can't just secretly take out a life insurance policy on my neighbor.
Absolutely not. Not without their explicit consent. This is a massive safeguard against potential foul play, the classic murder for insurance scenario. It fundamentally protects individual autonomy.
That's a cornerstone protection. What else in formation?
Article 39 handles retroactive insurance, similarly to non-life void if the policyholder beneficiary knew the event happened or the insurer knew it didn't. And Article 40 mandates document delivery, like non-life, but it must include the beneficiary's name.
Okay. Moving to Section 2, effect. How do beneficiaries work?
Article 42 says if the beneficiary is a third party, they automatically enjoy the policy benefits. Standard stuff.
But can the beneficiary be changed?
Yes. Articles 43, 44, and 45 cover change of beneficiary. The policyholder can change the beneficiary anytime before the insured event happens, just by notifying the insurer.
Okay.
You can also specify a change in your will, but, and this is crucial again for death insurance, you need the insured's consent to change the beneficiary.
So even if I'm paying the premiums on someone else's life insurance, I can't just swap out who gets the money without their agreement.
Correct. Another layer of protection for the person whose life is insured.
What if the named beneficiary dies before the insured person?
Article 46 handles that. If the beneficiary dies first, then all of their heirs become the beneficiaries, sharing the proceeds.
So the benefit doesn't just vanish, it passes down the line. That's smart.
It is. And mirroring the consent rules, Article 47 says for death insurance, you can't assign the policy rights or pledge them as collateral without the insured's consent.
More control for the insured individual. What about decreasing risk, like in non-life?
Article 48 allows the policyholder to request premium reductions if the risk significantly decreases. Maybe the insured quits a dangerous hobby, for example.
Okay. Section 3, insurance claim payment for life insurance. How does this work?
Article 50 requires the policyholder or beneficiary to notify the insurer promptly upon learning of the insured's death.
And when can the insurer refuse to pay? Article 51, exemption of insurer from liability.
The grounds are very specific and limited. Insurer isn't liable if the insured committed suicide. The policyholder intentionally caused the insured's death. The beneficiary intentionally caused the insured's death, though if there are other innocent beneficiaries, they might still get their share.
Right.
Or the insured died due to war or major social disturbance.
So it's basically suicide, murder by policyholder beneficiary, or war. That's a pretty narrow set of exclusions.
It is. It makes life insurance payouts quite reliable unless there's clear malice or a catastrophic event. And Article 52 sets the due date for payment after a reasonable confirmation period, with the usual caveat about obstruction causing delays.
Okay. Section 4, termination of life policies.
Article 57 covers cancellation on material grounds, similar to non-life, but specifically adds the policyholder or beneficiary intentionally causing or attempting to cause the insured's death.
Makes sense. And Article 58 is fascinating. Request for cancellation by insured.
Yes. If you are the person insured under a death policy taken out by someone else, you can request cancellation under certain conditions.
Gotcha.
Like if the policyholder or beneficiary has acted in a way that undermines trust, or there's been a major change in circumstances, like a divorce ending the family relationship that justified the policy initially.
Another unique protection giving power to the insured individual.
Absolutely. Article 59 confirms cancellation isn't retroactive, same as non-life.
Now, Articles 60 to 62, effective cancellation by third parties. This sounds complex. Creditors canceling policies.
It can be. It allows parties like attaching creditors or bankruptcy trustees to force the cancellation of a death policy to access its value. But
there's a twist.
there's a very interesting twist. The Act allows a holder of the right to intervene, typically a close relative or an insured beneficiary, to step in.
And do what?
They can prevent the cancellation by paying the creditor or trustee the amount they're claiming. Essentially, they can buy out the claim and save the policy.
Wow, that's a sophisticated safety net to preserve the policy for its intended purpose, protecting the family.
It really is. And finally, Article 63 gives us a key financial piece: refund of premium reserve.
You mentioned this earlier. What triggers it?
If a life policy terminates for certain reasons, like the insured suicide, cancellation by the policyholder before risk attaches, cancellation due to increased risk, or the insurer going bankrupt, the insurer must refund the premium reserve.
And remind us, what exactly is that reserve?
It's the portion of the premiums the insurer sets aside and invests over the long term to ensure they can cover future claims on those long-duration life policies. It builds up value over time.
So if the policy ends prematurely under these specific conditions, the policyholder gets back that accumulated value.
A calculated portion of it, yes. It provides financial equity. Article 64 then limits premium returns in cases of fraud, similar to non-life.
Okay, that covers life insurance in detail. Now, Chapter 4, fixed amount accident and health insurance. You said this mirrors life insurance a lot.
It does borrow heavily from the life insurance structure. Same ideas about disclosure, beneficiary changes, termination rules, the premium reserve refund. Many provisions are parallel.
So let's focus on the key distinctions. What makes this type unique?
Okay, Article 66 defines the grounds for claim payment. Specifically, it's triggered by medical treatment, death resulting from injury, illness, or other specified events arising from injury or illness, fixed payout for a health event.
Got it. What about consent?
Article 67 handles consent of insured. Like life insurance, consent is needed if the insured is a third party. However, there is an exception. Consent isn't needed if the beneficiary is the insured themselves or their heir if it's a death payment.
So if the money's going directly to the person who got sick or injured, or their family if they died from it, consent isn't required for the policy initially.
Right. But that exception itself has an exception. It doesn't apply if the policy only covers death resulting from injury illness.
Mhm.
Then you still need consent. It's quite specific.
Okay, that's nuanced. And insurer exemptions, Article 80.
Similar structure. Insurer isn't liable if the policyholder, insured, or beneficiary intentionally or through gross negligence caused the injury or illness event. Again, with a proviso for other innocent beneficiaries, or if it's due to war or social disturbance.
So broadly similar logic to the other types, just applied to fixed payments for health events.
Exactly.
All right, that brings us to the final chapter, Chapter 5, miscellaneous provisions. These apply across the board.
Yes, these are overarching rules. Article 95 on extinctive prescription, basically, statutes of limitation is critical.
What are the time limits?
You have 3 years to exercise your right to claim insurance payments, premium refunds, or the premium reserve. After 3 years, the right is extinguished. Gone.
3 years. That's important to know for anyone making a claim.
Crucial. And for insurers claiming premiums from policyholders, they only have 1 year.
Okay, shorter window for them. What's the practical takeaway here for listeners?
Deadlines matter. Don't sit on a potential claim. Act promptly. Understand these time limits, because if you miss them, you lose your right to claim. Simple as that.
Very clear warning. What about Article 96, bankruptcy of insurer?
If the insurer goes bankrupt, the policyholder gets a choice. They can cancel the policy immediately. Or if they do nothing, the policy automatically terminates 3 months after the bankruptcy proceedings officially begin.
Provides some certainty in a bad situation.
Huh.
And the supplementary provisions, Articles 3 to 6.
These are transitional measures. They basically explain that some parts of this 2008 Act also apply to insurance policies that were already in existence before the Act came into force.
So it retroactively applied certain protections or rules to older policies.
In some cases, yes. It just shows the careful thought that goes into implementing major legal changes like this, ensuring consistency and fairness across the board, not just for new contracts.
It demonstrates a really thorough approach. Okay, so let's try and recap this deep dive. We've really peeled back the layers of the Japanese Insurance Act.
They have. We've seen how meticulously it defines all the roles policyholders, insureds, beneficiaries, insurers, and their rights and responsibilities.
And we've highlighted those key distinctions, haven't we? Between non-life compensating actual loss and life and fixed amount A&H providing fixed payments for specific events.
Absolutely. And the specifics around consent, especially in life insurance, really stand out. Plus, the clear rules on disclosure, managing risk changes, how payouts are calculated.
Even handling complex things like overlapping insurance, subrogation, insurer bankruptcy. It's incredibly comprehensive.
It is, and what really shines through is that commitment to fairness and clarity. There is a consistent effort to protect the individual policyholder, and insured often overriding contract terms if they're unfavorable on key points.
Yeah, this deep dive really underscores how detailed and frankly protective a country's legal framework can be. It takes something potentially complex like insurance and tries to ensure fairness.
And understanding these fundamentals, even at this level, really empowers you, doesn't it? You can ask better questions about your own policies, navigate agreements with more confidence.
Definitely. So maybe a final thought for our listeners to mull over.
Okay.
We've looked closely at this one framework shaping insurance in Japan. So what other unseen legal frameworks, maybe in your own country or internationally, are quietly shaping other aspects of your daily life?
Interesting question. And how might understanding those frameworks, like we've tried to do with this act today, empower you, give you greater insight or confidence in navigating your world?
Something to think about.